Hello, Dr. Tim Creel here, and just wanted to give you kind of an introduction here to week 9. So I'm pulling this up basically on the screen. So in week 9, we're going to look at budgets. And budgets is a subject that, regardless of which area of business that you work in, you're going to see budgets. If you're in management, if you're in IT, if you're in marketing, if you're in accounting, if you open your own business, you're going to see budgets. And even in your personal life, you should have a budget. I mean, that's just a big thing with personal finance. So you're going to see budgets regardless of what you do. And so this week we're going to talk about budgets. In chapter 8, we talk about the master budget, which is kind of a series of budgets that flows down through the organization. Starts with the sales budget because sales drives pretty much all cost in an organization. And then from there, if it's a manufacturing environment, you would move to a production budget, which says, okay, if we're going to sell this much, how much do we need to produce to make that happen? And then from the production budget, you would have direct materials, direct labor, manufacturing overhead, and all these would be based on what your needs are and how much based on how much you're going to produce, the production budget. So you see it's kind of a flow: sales, production, direct materials, direct labor, factory overhead. Then you have a selling and administrative, which is your non-manufacturing budget, your cash budget, which looks at your cash position, kind of your cash in and your cash out. And are there times when you might need to borrow, during a period, for example? And then you flows down to a budgeted income statement, which is typically the point that declares, do you have a good budget or not? Management, a lot of times will say, we want to make at least $1 million. We want our net income to be at least $1 million. So you run the budget and you come up with 950. Upper level management might say, well, go find us $50,000. We want a goal of 1 million. And so a lot of times the budgeted income statement says whether you've got a good budget in place or not, and whether upper level management will sign off on it. And then the last, you would do a budgeted balance sheet, which just looks at your assets, your liabilities, and your equity based on your budgeted numbers. Now, chapter 9, we get into flexible budgets, and everyone does a flexible budget as well. What a flexible budget is, it's a little different than the static budgets that we looked at more in chapter 8. But a flexible budget, you would wait until the period is done and you would take whatever actual sales total you had on the budget and you would apply the same principles as you did with your static budget to that sales total. And what it does is it gives you a little better comparison, because if your sales are too high, it'll throw, your budget should be higher. Your revenues and your expenses should be higher than what you had budgeted. If your sales are lower, your numbers should be lower than what you had budgeted. So by doing a flexible budget, you basically redo the budget with your actual level of sales, and it gives you a really good comparison as to how you did with controlling your costs and expenses during the period. So basically you want to read chapters 8 and 9 this week. And then, of course, there is a lecture video and a reading assignment in Connect this week. Have a fantastic week and get with me if you've got any questions. Take care. Bye-bye.